and welcome back to another episode of the Financially Fit Podcast. I am your host, Andre Creighton. As always, I'm so excited to be here with you all, and I we are halfway through the year. That is crazy. 2025 has flown by, but you know what? There's still time to still work through the goals that we set at the beginning of the year and continue to maybe recalibrate. This is a good time to maybe recalibrate if maybe you've hit some of those goals, maybe you've exceeded those goals, maybe it's time to reset new goals, or maybe you have struggled with your goals and now this is time to double down on those and continue to try to strive for those. So with that being said, today we're going to talk about the wealth triangle. The wealth triangle being income, investing, and ownership. Yes, that is right. Income, investing, and ownership. So you might often hear me in the most of our podcasts saying, this phrase, it's not about how much money you make, the power is in how much money you keep. Well, this episode is for you today. This episode talks about that phrase and what actually I mean by that. So, uh, there's this thing called the wealth triangle, and what it focuses on, yes, you want to have good income. Yes, you want to be able to use that income to invest and also be able to find a way to get some ownership. And we're going to go through all three scenarios and get a better understanding of what all of that means. But the core theme today is that wealth isn't just about how much you make, it's about what you own that continues to grow without your constant effort. So let me read that one more time. Wealth isn't just about how much you make, it's about what you own that continues to grow without your constant effort. I love this because something that now that I'm in my almost mid 30s, have been striving for is I'm at a place where humbly I make good money, and now it's the other two phases. Where am I investing my money? Do I have ownership in things that are going to continue to appreciate over time and be able to build that wealth that I need to be able to sustain not only what I love to do and maybe my goals for my family, but also for generations to come. So, you know, most people tend to chase income, and the reality is that the wealthy chase ownership. So I'm going to read that one more time. Most people chase income, the wealthy chase ownership. So you might ask yourself, why is that? Well, the reality is that ownership is going to appreciate over time, right? Uh, we hope, right? Depending on what you're invested in or what you own. But traditionally, the things that we try to own, whether it's real estate or maybe it's some IP, whatever it may be, we want to see that appreciate over time and continue to grow, right? Example of that is, back in 2005, my parents bought our first home, and I think they paid like, gosh, like 209, right? And now it's worth, I don't know, 350, maybe close to 400,000, right? So when we talk about that appreciation of that real estate, and also, they've paid that down over time, right? Where to a point where it's probably almost paid off, right? So now when they get to that point where it's paid off, maybe they want to sell and downgrade. They've gotten that appreciation over time, and now they'll also be able to capitalize on the fact that they don't have any debt on that home, or they have the flexibility to take out some equity on the home, because it's appreciated over time, and be able to use that money to, oh, sorry about that, bless me, to maybe improve the house, or maybe they want to pay off some other debt, maybe they want to buy a vacation home or a timeshare, whatever it may be. Now they have extreme flexibility. So that's why it's always, important that we are chasing some type of ownership. So, uh, the wealth triangle talks about, like I said, income, investing, and ownership. But when you think about the wealth triangle, it's earn. So you want to earn, and that's your active income, right? And then there's also invest, which is your passive income and growth, and then own, which is equity and control. All three phases are important, and just no matter where you are in those phases, um, it doesn't mean you're behind or that you're doing things wrong. It just means that it's a good opportunity for you to evaluate, where is your money in those three buckets, right? And if there's opportunity where maybe you are you have very good active income, and maybe you're doing a little bit of investing, maybe you don't own anything. Well, maybe we start to look at, what can we own? Maybe it's a franchise, maybe it's buying a home. Or, maybe we have, you know, good income, and we're not investing much, but maybe we own something. Maybe we don't feel comfortable with the stock market. This is a good time for you to go and get a financial planner, right? And think about kind of holistically, how do I better diversify my portfolio? So let's talk a little bit about the income piece. So the income piece is the foundation. The income piece is the foundation. So income is, do your W-2, any freelance work you do, only on earned income, is you're trading time for money, right? So, when you think about that, there's time is not infinite, it's finite, right? So we know that we can only do so much with the time that we're giving. So if you're relying solely on earned income, you're trading time for your money. You're also trading time that you could be maybe traveling with your family, or maybe you could be, doing some leisure thing that you enjoy. Like I used to love coaching high school football. Like I would love to do that again someday, right? But the reality is that that was taking too much of my time, along with my full-time job, along with some of the side things that I do, along with, also having ownership in the company, and then doing actual individual investing on my own, and all of those things. And I had to say, you know what? I can still do good in my community and take a step back, and focus on the things that I need to do to drive myself forward. So then when I do get back into this, I can give my whole self, right? And not half of myself, right? So I think that's important. Obviously, we need to understand the difference between, uh, you know, lifestyle creep. So, you know, you don't get rich by getting raises. If your raises are just increasing your spending too, right? So a lot of times people, they get a nice promotion or a raise, and this is a great opportunity for them to think about those other two buckets: investing or getting ownership. But a lot of times people just increase their lifestyle, right? They start to do more lavish things. They buy a new car, or they're going out more, and going to the more fancier restaurants, or maybe they're buying fancier clothes, whatever, or going on fancy vacations, right? Whatever it may be. And those things are great. However, doing those things with clear, defined budget on how I'm utilizing that money is very important. So, the takeaway with income is earn more, but don't stop there. Use it as fuel for what we're going to talk about in number two. So, number two is making your money work. So, what is investing really? It's investing in stocks, it's real estate, it's index funds, it could be startups or angel investing, et cetera, et cetera. At the end of the day, we want to get that compounding interest. Whether that's investing in a money market, or that's investing in stock, or whatever it may be. We want to get compounding interest. We want to be able to see and play on the interest rates to continue to increase that money, and have our money working for us while we're sleeping. Right? That's what we call passive income. So while I'm at work during the day, right, and I'm invested in the stock market, I want to see my money that I'm invested in various stocks or ETFs or whatever it may be increasing, while I'm also making money on the clock in my regular job. That is how you start to build wealth. Um, so the other thing I always find is people that are new to investing, they always say like, "Hey man, this game's not for me. Like I don't have enough money like to play this game." That's so false. You can start small. I remember back in like 2015 or 2014, I started on Stash, and I was just investing $5 every week. Every week I was investing $5 in an ETF, and then I increased it to 10, and then I increased it to 50, and then I increased it to 100, and then so on and so forth, right? So time is always going to be greater than timing. So the earlier you start, the less you'll need. So don't let the time, or don't let the timing stop you from taking that leap, right? The sooner that you learn and you make some mistakes, the better you're going to be in the long run, right? The longer you wait, it's inevitable for you to make. You're going to make mistakes in this game, especially when you're playing stocks. I play the stock game and I've done really well. I just looked at my portfolio, and just in the last quarter, I think I'm up 16%, so I'm doing much better than the even the S&P is in the last 3 months. So, but also it could be 25% if I didn't have a couple stocks that were losing, right? But the reality is that's the game you play, right? You're going to make some bets, and some bets are going to be great, some bets are going to be bad. I just recently this week hit on an option. It was my first option I've ever done, and it was in SoFi. And I put this option in May. I put two contracts out for a long call that it would hit $17. At the time when I invested, it was at like $12, and I said it would hit 17 by March of 2026. Well, this week it hit over $18. Right now it's at like $18.52. So I ended up selling one contract, took my profits, that covered what I had initially put in, and then I left one contract to see, like, hey, will it go higher from now until March? And now I'm playing with house money. So just but then on the other side of that, I put an investment into Lucid, which is a big EV, and it's hasn't been doing well. I've lost I think like a couple $100, 200-300 bucks on it, but still, like, it's money, right? And but I couldn't foresee that, big beautiful bill was going to go through, and like they were going to take away the EV credits. I couldn't see that Elon was going to be in the situation where, you know, uh, Tesla and upsetting shareholders and such, and how that might impact Lucid, especially with how Trump and administration seem to be moving on the EV stuff. But you know what? You win some, you lose some. So, um, the last thing I'll touch on investing is like the reason why it's so important just to get started is you can always DCA. DCA is dollar cost averaging. So, you know, this is a way to accelerate wealth. You want to continue to ride the dips, and as it's continuing to increase, you're watching, and when stocks are dropping, you're gonna invest, and what that's called buying the dip. And it will allow you to bring down your dollar cost average. So that segues us into number three: ownership. So this is the wealth multiplier. So, ownership is equity in a business, it's real estate, it's intellectual property. I This is something that I didn't know a ton about in my 20s that I wish I did, but like for those that have been listening for a long time, I own a tech company. The tech company is doing really well, but that's not my day-to-day job anymore. So I'm sitting here, and I hope in 10 years or 15 years, or maybe it's 3 years or 5 years, whatever it is, that I get a return on that, right? And I was at another company, tech company, and had some small ownership. We sold to PE, and I got a small payout for that. That is what we talk about when we talk about wealth, right? Large lump sums of payment that we can use to fuel our other two strategies, whether that's having the ability to invest more, maybe it's having the ability to have more flexibility to do more and earn more money, whatever that may be. But it's so important to find those ownership opportunities. The benefits of ownership are it helps provide control, cash flow. Obviously, you get the appreciation and you get leverage. Those four things are so important: control, cash flow, appreciation, and leverage. I want to be in a position where I have leverage over my life, where I have the ability to do the things that I want to do because I've done the right things and I have ownership, and knowing, also I own a house, right? I know that me and my wife, humbly, we're in a really, really nice house. We're very fortunate. But we didn't start here. I started in a apartment, that I met my wife, and we had a house, and it was a very nice house, but we were outgrowing it, and then we were actually able to use the money from the proceeds from that house to get this house, and someday this is our dream house, and someday we will be in a position where our kids will be out of the house, and we'll say we don't need this much house, and we'll sell the house, hopefully at a profit, and be able to use that money and downgrade, and that is the way that we're accumulating large lump sums of money through ownership. Um, so, there's a difference between an employee, an entrepreneur, and an investor mindset. An employee goes to work every day and they say, "Hey, I'm just here to make my check, to make ends meet. Maybe I love my job, but I know this is steady Eddie, and I know that this is going to provide for me and my family to hopefully get to the life that we want to live." And an entrepreneur thinks that big. They think, "Hey, I have the next unicorn billion-dollar idea." When Jeff Bezos uh, was building Amazon in his garage. Um, he didn't know what Amazon was going to be. It started out as a bookstore, and now that company is worth billions and billions of dollars, right? So when you think about just accumulating wealth, the entrepreneur always has their thinking is at a 10,000-foot level. They're thinking bigger and further out than most people, the normal average person. And that's what really drives wealth is, and then also being able to take that risk. They're risk takers, right? When I stepped out to be an entrepreneur, it was more about, I've been in corporate America for over a decade. I know that I've built a good skill set, and what am I doing to use those skills to build something monumental for me and my family, but also for that can change the world. And um, you know, now I'm back to being an employee, but I think that I learned so much in that entrepreneurial journey because it challenged me. It challenged me every single day. I was striving to build something that had not been built. But it also put me in a different arena of people where I've made so many connections that are driving my ability to drive my income now being back into the corporate world. So, you know, I would not have had a lot of those relationships, or it would have taken more time if I had not stepped out on as an entrepreneur. So while I say that I didn't make as much money as I make now as an employee, what I will say is that being an entrepreneur expedited my career by at least 5 to 10 years. And it expedited because of the social capital. It expedited because of how it allowed me to showcase my skills to the world and the community that helped me land the job that I have now. So at the end of the day, start where you are. If you have high income, invest. If you have low income, increase skills. The rule of thumb is to allocate income into needs, future investments, and ownership goals. So, needs, future investments, and ownership goals. The wealth triangle in practice really, obviously your 9 to 5 job is where you earn. Your 401k or index funds are where you invest or stocks. And then, obviously buying a duplex or start a side hustle, that's your ownership. So I challenge all of you, and all of you can be an owner in some shape or form, whether that's owning a home, whether that's starting a business, whether that's you have some great idea and you want to get IP on it, and maybe you never start the business, but if someone does start the business, they can buy the IP from you or whatever it may be. All of us are very creative and we have the ability to do those things. So I wish you the best on your journey. Hopefully you learned something today. Thank you for rocking with me. I really appreciate you guys. We're halfway through the year. Let's recalibrate and let's keep hitting those goals. And thank you for joining the Financially Fit Podcast. I'm your host, Andre Creighton. It's not about how much money you make. The power is in how much money you keep.
You know Shaletta makes you laugh, but did you know Shaletta Brundage can also make you think and boost your business? Media personality, activist, and comedian Shaletta Brundage founded Shaletta Makes Me Laugh to celebrate and share the best of Black culture. It's a podcasting platform. You can download 10 weekly podcasts hosted by African American subject experts at ShalettaMakesMeLaugh.com or wherever you find your favorite podcasts. ShalettaMakesMeLaugh.com is also a production house, creating broadcast quality commercial content. And Shaletta and her team of storytellers create powerful promotional campaigns to get businesses the brand awareness they're looking for. Some of Minnesota's top businesses trust Shaletta, and you can too. Get out the word about your events and products and get in front of communities of color with ShalettaMakesMeLaugh.com. She's got the power to help your business.
To keep my home running smooth, I count on Xfinity Internet. With 99.9% reliability, we're all online at once. No slowdowns. The Xfinity app lets me manage our Wi-Fi and keep things secure. Xfinity makes it easy.